Hello and welcome to a brand new show of Market Makers. My guest on the show today is Prabhat Avasthi of Nomura India. Prabhat, welcome to the show. Thank you for joining us.
Thanks.
Prabhat, if I map the current market environment, Indian markets are up by about 12.5% from the recent lows in the local currency term. So what has done the trick for us? Environment, risk-on trade or valuations?
Well, I think a large part I would ascribe to risk on. So I think we got three things which I would say sort of did the trick. Three or four things. One was the oil prices fell, commodities, and I think that is typically positive for Indian markets, especially in relative context. So I think and there is enough evidence to show that India tends to outperform regional markets when the commodity prices are falling and vice versa, because we are far more sensitive on current account and inflation to commodity prices. The second was that there was a risk off, and India high beta to risk off. So there was a sell off which was pretty strong. Third was, I think, some optimism on policy, which happened. And lastly, I think technically people who are underweight have been underweight India. So as a result, when markets sort of go down very quickly, then they tend to bounce back a bit, especially because domestic investors are sitting on cash. The global investors have been largely underweight, and that I think was one of the reasons why you saw this buying coming back, institutional buying into the market, which had relatively lower volumes. So the fact is that still the bounce back in the market has not happened with massive degree of conviction. Otherwise, you would have seen far more participation in the market. The participation has been reasonably weak given the volumes.
So do you think the best part of the summer rally is now behind us?
And it's very difficult to say short term, but I would think yes, because the valuations we are at 13 times now. Now, if you look at India's average sort of valuation last 10 years or 5 years, we are average of 15.5 times, which is we're about 15% away from that number. But that 15.5 came on the back of very decent macro environment, right? So we had 8 to 9% growth, decent amount of belief in 8% growth, probably 9%, and we had decent global economy at that point in time. Policy issues were not so stark. So given that, a discount is appropriate to long-term average, and so if you were to really look at where the markets could trade to on an upside scenario, then I think even if you assume that you need a 10% discount, your best case return will probably be in a 12-month period about 10 to 15%, which is not really that far off from bond return. And markets tend to perceive that very well. So I think to that extent, the upside starts getting limited from here.
When we started the year, the best case scenario was that for the current calendar year, Indian markets will appreciate by about 15 to 18%. 15 to 18% we've already appreciated in this calendar year. So I guess the best part is already behind us now.
Well, the best part of the rally was till March. We are still below that. So in fact, when we started in January, we were bullish for some right reasons, some wrong reasons. So when we actually were bullish, we sort of thought that there will be a correction in interest rates because of the fact that the economy was already slowing down, and we thought that as the economy slows down, current account issues will be less relevant, and that will give a fillip to the markets. What has actually transpired is that data points have been worse. So we actually downgraded in March, which was primarily because we really started getting rid of the external account, and the consequence. And I think the data points in global economy has been weaker. So you're right. I mean, the market has given 15-18%. Incrementally, when you look at what is going to happen incrementally in the economy, it's likely that your earnings will not be as robust, given the fact that the evidence of slowdown in actual demand numbers for companies has been on the margin negative. We've seen auto numbers deteriorate. We've seen slowdown in cement. We are hearing about steel sector demand slowing down. We are starting to hear about tech sector also getting impacted by global slowdown, and the volume estimates are sort of going down. So in an environment where earnings are not robust, it's very, very tough for markets to perform. In fact, earnings revision are an absolute necessity at times for the markets to actually move up. So if earnings revision on the balance start moving down, then I think the case is there could be some short-term downside as well.
What about valuations? Historically, we've seen maximum money is always made when macro is bad, environment is tough, but valuations are attractive?
So the valuations have to be seen in the context. So first of all, global valuations have come off far more than Indian valuations have. So the fact is that India's premium over global market has come off, but it's sustained to a large extent. There are markets which are level at 10 times. India is 13 times today, so 30% premium, despite the fact that growth differential has shrunk quite a bit. The second problem is that I think from valuation perspective will be that you're still evolving in terms of earnings. So earnings estimates have sort of been cut on a progressive basis. There is more optimism in the future because there is some inbuilt recovery in economy that is sort of built by analysts, not really, I wouldn't say by economists, but analysts have this bias of going back to 20% growth after a bad year. So that I think is the second thing that I think is. And lastly, the fact is that earnings yield in India compared to corporate bond yields, I don't think there is that case you can make that earnings, equities are cheaper than bonds. They're not. So the fact is that with respect to bonds, equities have not become cheaper. That typically is the best time to buy, and that usually happens when people really give up or capitulate. So I don't think you are in a situation where you can say, well, the markets are so compelling that I'm going to make tremendous amount of returns. They're not really cheap. They're cheap with respect to history, not with respect to bonds, and not with respect to regional markets.
Prabhat, but in the near term, do you think globally markets are pricing in too much of risk? There are record inflows in German Bund, US bond yields. They are now offering less than 2%, but still they're getting inflows on a daily basis. Do you think such a high level of risk is unlikely to sustain, and whenever money will come out, it will flow back into EM equities?
So that's an argument which has been made for a very long time now, because the bond yields have been very, very low for a fairly long time, even just out of the crisis, because of the monetary easing. There has been a significant amount of obviously yields have gone to almost negligible levels. I think the argument of in the global markets, the argument of earnings and bond yields that you're talking about works only if there is the classic argument is that if yields are low, clearly economic activity will pick up, and therefore you should be. But the problem is that given the deleveraging that is going on, given the sovereign problems that are being faced, your yields are low because there is so much risk to higher yields to economic activity. The fact is that you're not seeing any growth delta even after such low yields, which essentially argues for what? That the fact is that if you didn't have this yield support at lower levels, your economic activity would have probably collapsed, or you would have seen much worse problems then. So in such a situation, that argument I don't think really is that straightforward. In a normal scenario, bond versus equity argument is far more valid than in a scenario where you're sort of struggling to keep your heads above water as it is. I mean, you've got a crisis in Europe. You think they can take higher yields? They already are sort of struggling with higher yields in a lot of markets. So I'm not sure whether that argument is really all that valid at this time.
If the investment cycle fails to pick up in next 6 months, in next 12 months, do you think Indian markets could go through a permanent derating?
So permanent is a long term. I think from our perspective, permanent probably 3 years. So it's quite possible that if the investment cycle doesn't pick up, then the growth trajectory that you expect out of India will be more muted for a prolonged period of time. So if you look at how the growth expectations in India have changed, people started with 9, they went to 8, then went to 7, have come down to 6. But there is always a recovery expectation 2 years down the line, and that is because you sort of think that policy will be all right, things will come back. When this perennial argument about when India goes into a turmoil, everybody wakes up and they start doing the right things. And I think that is the belief which is why you sort of continue to say that things will recover, and that's a valid argument, frankly. But I think the break in investment cycle that has happened because of last 2 years of inaction will definitely tell on growth for a reasonably long period of time. Because I'm going to give you a few examples, like power sector. You had so many generation capacities which are coming up. But given the coal situation, I don't think anybody will get a bankable project for next 2 years because there's no coal, right? So you cannot really set up a power plant without. So for 3 years you will not have a new project being announced, which essentially will mean that with a lag, the entire execution cycle in power will start to fall off. The same thing is probably going to happen to sectors like telecom, in metals. That same things. You look at the amount of projects being put up by Hindalco, Vedanta, and what will they do in next 2 years? There's hardly anything on the slate. So the danger now is that because you've seen a break in the cycle, the re-acceleration of the investment cycle will always be a lag process, and more we delay in terms of getting that process back up, more danger is that you probably will have a more prolonged slowdown.
So based on the sound bites or the kind of feelers which we are getting from the center on New Delhi, you are not confident that the policy reform will kick in. At least you are not making your strategy piece based on a policy assumption.
So let's look at what has been announced and what is needed. So I think the announcements from Delhi so far have largely been towards easing of the bond markets, investment limits. So essentially what we're trying to do is trying to get capital. Because we have been short on capital and rupee has been depreciating. So attracting capital on higher yields, frankly, is not really something which is long-term desirable, because we don't want to should be taking more debt. As it is, our external debt is going up. The essential issue is that we need to have supply-side reforms, one, and secondly, demand-side, demand control through fiscal process. So as long as fiscal process, if the fiscal issue is not addressed, then you cannot keep taking more debt to just fix the problem. At some point I will come back to bite you again. So that I think is the key. So I would like to see the two serious reforms. One is on the supply side. So that basically means that stable policies for investments to get off the ground across sectors. You cannot have a situation where I put so much money in a power plant just to find out that that return is not going to generate even 2% ROA. Or for that matter, same thing in telecom sector, for example. So stability of policy and clear thought process about how to generate investment activity, especially given the fact that globally there are no opportunities. You've got to create domestic opportunities through infrastructure and local sectors. And secondly, as I said, just to get the fiscal side right, not inflame the consumption more, reduce consumption, emphasis, go into more investment places. And that I think, till the time we see signs of that, just attracting capital will be a very short-term measure.
So which sectors they tend to do well in a market like this? Because so far, those who've invested in defensives, they've made money. But now for the first time, the defensive trade also seems to be reversing.
Yes. So I think what's going to happen is that consumption usually is far more resilient in the short term than investment, and that is because even now, for example, anecdotally, that India has faced a labor shortage, and that is not really eased. I mean, you're not seeing salary cuts in India. The salaries are still rising, though at a slower pace. As investment cycle starts to come off, there will be at the margin impact on consumption because job prospects will start fading, salary increases will reduce, and stuff like that. And therefore there will be a slowdown in consumption. I think where the stock prices of consumer stocks were, they were reflecting more of a fear premium than really the absolute level of fundamental multiple at which they should trade. The question is, in a slowdown situation in overall economy, will that relative trade hold out or not? And I guess if you're 2 years slow on growth, which is our forecast, for example, closer to 6%, then that relative trade will probably still hold out. There might be periods when there is a risk on and these guys underperform and people try to shift their portfolio away from defensive and you see
so don't sell consumer.
I think you need to, even if in a portfolio, I think it is still very advisable.
Within the consumer space, what are you hot on? Discretionary, staples,
discretionary more risky because there are two reasons. Discretionary have more urban-centric sort of consumption, right? So urban-centric consumption is probably suffering more on account of the fact that there is clear shift towards rural consumption and the rural terms of trade have become better. I mean, we've seen a 20% increase in MSP. And any impact of an industrial slowdown will be first felt in urban India, not in rural India, because they're still far more insulated. So as a result of this, discretionary probably will suffer more, which is what again you're seeing in terms of, you look at the number of, let's say, a Bajaj Auto versus a rural focused player, and you can see the clear difference in growth rates. I think that might be it might be more advisable to sort of be lower in the pyramid chain and be in lower penetrated categories than higher penetration, more in rural, less in urban.